Hello, and welcome to Trading Without Fear. Hi, so welcome to Trading Without Fear. I'm here with Kelly, and he's an options trader. So what we're going to be doing today is just basically going over some brief introduction of options, how to read an options chain, and kind of going a little bit more in depth of that. We're not going to be discussing any sort of option strategies, nothing like that. So you can go ahead and take it from here, Kelly.
Okay. Hi. Nice to meet everybody. I'm Kelly. I go by Gambler6. That's my Twitter handle. And I just want to put a disclaimer out there, that, I've been trading options now for about a year, a little over a year and a half, actually. And so I've got some experience. I still consider myself a newbie, though, and by no means an options expert. I've been doing okay at them, though. I got introduced to them initially. I was in Tim Sykes in his challenge group, and while you're in there, got introduced to Mark Crook, who does Evolve Trader, and he's kind of like my initial guru that I started following and learning options from. I've also followed another guy named Theta Warrior on Twitter, and I've learned a lot from him as well. And then there's just been some tweaks along the way where I've kind of developed my own strategies and way of trading options differently. So I know options for me really was kind of confusing in the beginning. I looked at them a few years ago. Somebody mentioned to me about options and how you can make exponential money trading options. And so, of course, that got me kind of curious. And I looked at them, completely confused in the beginning because it was just tons of numbers, different strike prices. I had no idea what any of it meant. And I don't, despite my handle name, I don't really like to gamble when I'm trading. And so I just kind of left it alone. The more I've done it, the easier it's gotten. And there's 1,000 different types of ways you can trade options, but I like to keep it simple. And I just trade calls and puts. So some of the reasons why people trade options is because it's a great way to increase your account. If you have a small account that you're trading with, you can have exponential growth in that account if you trade well and you have proper risk management, just like any kind of trading. Some of the returns that you can get on options trading, particularly on intraday trades, you can get up to 100% or more. And you have limit, like some people like shorting, and you can get a lot of money shorting, but the problem with shorting is that you can have also exponential loss on that if it goes against you and you're in a squeeze. What's different is that with options, you can go long on puts, which is essentially shorting a stock, but you don't have the same risk that you do with shorting, because since you're long, you're actually buying puts, and the only amount that you can lose is what you've put in. So you don't have to worry about it going exponential if it squeezes against you. And finally, it's just an additional tool. So what we've kind of seen in the past several months with the market is that, OTCs have run hot and then they went cold. I'd say small caps are kind of like in a cold period. And so you might find some good high day breaks, or, whatever your day trading pattern is. But when there's a day where there's nothing out there in the small caps or in OTCs, options is another way of trading that can also gain you some profits. But what I like doing is trading options on the large caps. So whether that's Tesla, NVIDIA, you got AMD, AMC, whatever. So it just provides you another means to do day trading. And that's what I like doing, is day trading. I'm not generally a swing trader, but you can use options for swing trading as well. So one of the things I'd like to do, going over that, I was really, like I said, when I was introduced to options, I was really kind of confused about them. So I want to introduce everybody to the options chain and what that looks like, and go over some key definitions so that everybody really understands the basics of it. I'm not going to go into the straddles and all that stuff because that's kind of advanced level. So I'm just going to try and keep it simple right now.
So what is the difference between an option and actually buying a stock?
Okay, that's a good question. So the stock in options, we call a stock the underlying stock, right? So let's say you want to trade Apple, but it's too expensive. So you can use an option which trades at a fraction of the value of that stock. And when you trade an option, you're either trading believing that the price is going to go up, or you're believing that the price is going to go down. And you can buy a strike a strike price that you think it's going to get to. So let's say Apple's trading at 172 and you think next week it's going to be going up to $180. You can buy a strike at $180 at the price it is now. And as it reaches $180, your option price increases in value as it goes up. Now, each option is actually a contract. So if you buy one option contract, let's say you buy one contract of Apple for and you think it's going to $180, that represents 100 shares of the actual stock. I like to look at it like this, right? It's a briefcase of stocks. So you have a briefcase, it's got 100 shares of Apple in it. You're not actually trading those 100 shares. You're trading the entire briefcase of those shares. So that briefcase could only cost $10, but the value of the stocks inside could be $1,000. So it's just a fraction of the value of the actual shares. And we're not actually, if it reaches that price, you can actually then convert those and buy those shares at the lower price. So if it's at $180, but if it gets to $180 and then it goes parabolic and goes to 200, you can trade those shares in and you're buying them at $180. But when you do that, you have to buy the full 100 shares. So you would have to have 100 times $180. We don't do that in options trading as day traders. We're just trading that briefcase back and forth. That's all we're doing. So I buy it for $1.50. I hand it off to somebody else for $2. Now they've got the briefcase of 100 shares. That's kind of like a dummy way to kind of look at it, but that's how
I guess a way to simplify it is, let's say if you're in the market to go for, let's say, you want to go out and buy a suit, and let's say the day is Monday because they have an expiration date, which we're talking about. So if it's Monday and you want to go to a suit shop and you see a suit that's there for $1,000 and you talk to the owner and the owner writes a contract saying, between Monday and Saturday, you have the right to actually buy the suit for $1,000.
Right.
Let's say between Monday on Wednesday, George Clooney is on the red carpet. He endorses that suit and he says, this suit is a good place and it's a really good place to go buy that at this place. So on Friday, you go down there to pick up the suit and there's a whole bunch of people lined up to buy that suit. And let's say it's now increased to $3,000. Now you have an option. You have a contract saying that you can buy that suit for $1,000, but you also have the option to sell that contract to somebody else. And let's say if somebody buys it for $2,000, you pocket $1,000. That person has the ability to buy it for $1,000. They save money, you make money, and so it's not really owning any sort of asset. So in essence, an option is a derivative of the stock.
That's in a nutshell. You said perfectly. It's it gives the owner, whoever's holding that contract, it gives that holder the right, but not the obligation to buy or sell the underlying stock. Is the bottom line. You hit it on the head. That's exactly it. But it does come with an expiration date, and there's several different expiration dates. So just depending on which one you buy, then that's it. You hit it on the head.
And so there's no penalties or anything like that. Like if you buy a weekly option or a monthly option, if you sell it before the expiration date, do you get penalized for that?
Nope, not at all. I trade it just like I would a stock. So and as a matter of fact, that's how I trade them. So if I want to buy an option in Apple, I'm actually watching Apple at the same time I'm in that share, that option that I bought. So, and I'm just trading it along with it. And we'll kind of go along, and I'll show some examples on that too later on.
Sounds good.
Let me go ahead and share my screen here. I'm going to show you my E-Trade. I use E-Trade Pro. Okay, you should be seeing my E-Trade Pro now.
Yep.
Okay. So when you go, if you're using E-Trade Pro, the way to get to the options chain, you just go to your tools, and in tools, you just come down and click on options chain, and this little box is going to pop up. And it'll just, it'll probably pop up with the queues preloaded. That's what they always do. So from here, you have several different chains you can look at. If you do this little drop down where it says calls and puts, so you type in your symbol here. Right now, I've got it on AFRM. But if you go down here, you can look at just the calls or just the puts, all these different things. I just look at calls and puts, because what I'm trying to do is, on the left side here, just to orient you to my screen, I've got a stock that's up that I'm interested in this case, AFRM. I've always got the queues up if I'm trading like NASDAQ tech stocks. Then I've got my level 2, and I've got time and sales over here. I'm just kind of watching them all at the same time, particularly time and sales. I'm watching for green tapes or red tapes coming up and down. And on the stock that I'm interested in, I always go to the 3-day and I look at the intraday trading on it. So I've got AFRM pulled up. I pull up the calls and the puts. And when you're looking at calls, a call is on the left side, puts are on the right side. A call means that you believe the stock is going to go up in price from wherever it's at now, right? In the middle, you've got the strike price, right? And then like I said, you got a put on the right side. A put is that you believe the stock is going to go down in price to meet whatever strike price you believe it's going to go down to.
Yep. And a good way to kind of remember what they mean, because calls and puts are different than going long or short, is you can think of it as call up versus put down. So if you want something to, to go up, you want to call it. So you call up, and then if you want to put something down, you can put down. So
that's
yeah,
I never even thought of that.
Remember it. Yeah, that's kind of the way I've remembered it of how to do it. So I've noticed on your calls that there's some shaded areas, and on your puts there's non-shaded areas. What does that mean?
Yeah, so this is it's kind of a quirk whenever the market closes. So normally when it's shaded, that's what's technically in the money. So on this one, right now, AFRM's at $62.88. So anything above $62 and above is in the money. So let's see, or not above, excuse me, anything $62 or below is technically called in the money. And what that means is the price has actually reached the strike price. And that gives it value now because it's actually kind of like in the zone, right? It turns black if it's not in the money. So if it's out of the money, then the price of the stock hasn't been reached yet. And when it's out of the money, then we'll talk about the values in a little bit, but that's just what the black and gray shading means. Normally over here, it looks opposite. So whatever's shaded on the left side, then on the right side in the puts, the opposite will be shaded, because over here on the puts, anything that's 63 and above is out of the money. So that's just how we look at it.
Okay, because on mine, because I'm pulling along on Thinkorswim, and mine is showing shaded on some of those. So
yep. Yeah, that's just a quirk on E-Trade once the market closes.
Yep.
Now up on the top, you'll see there's several different dates, right? So we talk about options. There's an expiration date on options, right? So the last day the option, and that's the last day that an option holder can trade the option or exercise the option that we were talking about before. They always expire if you're, we mostly in the past, it was almost all monthly options, right? So you have a monthly option that always expires on the third Friday of the month. And if you go to like most SPACs, just because this one stands out in my mind, let's look up lottery, right? If you look up lottery.com, which is a SPAC or a former SPAC anyways, they're all just going to be monthly options on there. And they always expire on the third Friday of the month. But as time progressed, we got more traders, we started seeing many more options. And so they went to weekly options, and you also have daily if you're trading on the indices. What's important is that the closer you get to the date of the expiration, the less value the option has, right? So let me see, I'm looking at two different ones, right? So let's just say, so this Friday is, this coming up Friday is going to be the 11th. And if we're looking at $62 calls, they're $7.40, right? If we look at next week's expiration period, February 18th, and you look at that same number, it's worth $8.55. So it's worth a little bit more. And it's the same, the further on down the line you go, or the farther in the future you go, the more stable that price is for that particular call or put option, right? So the same put option on April 14th at 62, no, they don't even have a $62 option, but it'll be trading somewhere around $11.50. And it's just a stabler price because it's further down and a lot can happen between now and April. For day traders, the way I trade, I don't go that far down usually. At best, I might go 2-3 weeks in an option chain, depending on what I'm trading.
So when you're saying that far down, you mean further out in the future as far as the date-wise goes?
Yeah, so like a lot of, especially like hedge funds or or experienced traders that are like hedge funds or whatever, right? So some people will buy Tesla a year from now, anticipating that a year from now Tesla is going to go up $1,000. We all know that between now and the end of next year, Tesla's probably going to go up. Do we know, do we want to sit there and bite our nails on every move down it does? No, because we know it's going to have good days and bad days. There's going to be bad news that comes out and good news. But if you just want to keep your money safe and in an investment type scenario, you could buy January, the third Friday in January for next year on Tesla at $2,000 or even $1,000. And if it goes up significantly in price, then you stand to make money in January next year. So that's kind of the idea behind that. Now, again, as time goes on, though, you've got two types of value that affects the value of an option, and that's called intrinsic value and time value, right? So, with intrinsic value, that's a share. The technical aspect of that, I guess, is intrinsic value is the share price minus the strike price is called the intrinsic value. And if it's negative, the intrinsic value of that call for a call option would be zero. And it's the opposite if it's a put. And that's like complicated to me, right? Because I'm not like a big math person. But you've also, aside from the intrinsic value, you got this time premium, and that value of the option, the value of the option in excess of the intrinsic value is determined by the market and based on time. That's the official definition of it. What that tells me in layman's terms is the value of the option goes up as the price of that stock goes, if you're in a call, goes up as the value of the stock goes up, right? So they're kind of parallel. If you look at a chart, and I didn't know you could do this originally, if I click on the $62 strike, I can actually pull up a chart on that call and see how it's trading in relation to the actual stock. So you do the 3-day, you can actually see how as AFRM was breaking out on Friday, that option is also going up in value and trading almost parallel with it. It's just at a lower value. So the price is increasing. What you're not seeing, though, is that the price, the time decay, and there's a time decay in options because as time gets closer and closer to that expiration, it's decreasing or depreciating the value of that option. Does that make sense?
Yeah.
So, and I have a chart. Let me actually show you a good example on that. Let me share. Okay, you should be showing a PowerPoint real quick.
Yep.
So let me show you on Chewy. So this was a breakout yesterday as well, right? So in the morning, Chewy broke out at the $45 level. And so I pulled up on the left side on the bottom, you're seeing the $45 call that expired on 11 February this week. And then on the right is the same call, but for the expiration that happened yesterday on 4 February. And so what you're seeing is they both started out at about $1, the call options. And then when it broke out, you can see how the option made this little parabolic move, right? So on the 11 February one, it actually went all the way up to $6 at the end of the day and had a pullback to $5. But when you look at this one that expired on the 4th on Friday yesterday, you can see it also went way up and went up to $5.50. So they both had huge exponential gains for the day. But the closer it got to expiration, the quicker the decay happened on the one that expired yesterday. So it actually closed at $4.42. It was still really high on the day, but it didn't get as high as the one that expires next week because there was more time value. So that time value decayed much less on next week's strike or next week's option chain than the one that expired yesterday. Does that make sense?
Yeah. So like if you're looking at, let's say, a weekly option, and let's say it's 11th of February, which is going to be next, well, it's the one that I'm looking at is the 22nd of February. So if we're looking at the 22nd of February, if you're trying to day trade that, does that mean it's better to push it out further, or is it better to try to keep them in weeklies?
Well, that's a good question, actually. So that's one of the things that I wound up having to kind of learn on my own. Like, when is the best day to get into an option? I'm just going to get back. Are you seeing the E-Trade Pro again?
Yeah.
Okay. Yeah. So there's several different. Okay. There's a lot of different setups, but there, it all kind of depends on how much volatility is happening in the stock. How to determine when to exactly buy the option. So it kind of, one, depends on the catalyst that's happening at that moment in time. But for me, I generally, like, if it's a Monday or a Tuesday, I'll buy the options that are expiring that week, because one, they're a little bit cheaper than if I'm buying next week. Let me pull up Tesla, because this is, people trade this one so much, and at least I do anyways. I've gotten to know the stock pretty well, and I know that if I'm buying into the second week out, I can't afford it. I don't want to afford it because it's too expensive. So, and they're still a little expensive right now because technically the week hasn't started. On Monday, all of these are going to depreciate, right? So if you're trading, let's say we think Tesla's going to go up to $950, right? If you're on Monday at $950, it's trading at roughly, well, at $18.15 if you're buying on the ask, right? If I'm buying the following weeks, the same 950 is $30, right? So that's a little steep. So for me, if it's a Tesla stock that I'm trying to trade, I'm almost always trying to trade the expiring week that I'm actually in, just because it's cheaper, up until about Wednesday, because once Wednesday comes, theta decay rapidly decreases the cost. So if I'm in a trade and it goes against me, I'm going to lose exponential profit, or I'll have exponential loss because of the time decay if it's working against me, whether I'm buying a put or a call. It doesn't matter which direction. If I'm losing, it's going to lose rapidly, and if it doesn't get back to my strike price, even if it gets back to my strike price, it may not be worth the same amount. And actually, I got a chart on that too. Let me reshare this because I wanted to highlight that. Go back. You should be seeing the PowerPoint again. This was Tesla yesterday somewhere. So on Tesla, let's say people talk about doing a YOLO, right? Well, if you were trading Tesla, and at the bottom, this is the Tesla chart, what it looked like yesterday, right? So about 315, about 315, it was trading at about $935, $936. It looked like it was going to be a breakout going to 950. So if you had bought that at about 3 o'clock on the first little bump up, your call option would be 50 cents. Now, when it came back to it 15 minutes later and actually broke out, that same call option was worth less, even though on the underlying stock, it was higher than where you originally bought it. It never actually got back to that price because of the time decay, because I'm looking at the 4 February expiration. So the closer we're getting to the end of day, the closer that strike, if it doesn't get to that strike price, the more value it loses. And eventually we saw, like, there was a point when Tesla started going down, there was no way that that was going to be getting to $950. So it actually went down to zero. Now, if Tesla broke out, and we've seen Tesla squeeze, especially towards the end of the day, this 50-cent call option could have easily gotten up to $4 if it actually got to $950 because of how it squeezes. So if you turn around and you look at the put on the right side, this is the put. So converse to the call, which you're thinking it's going to go up to $950. If you had bought the $925 put thinking it was going to go down, it also started out at around 50 cents over here. But when it actually started going down and actually hit $925, that 50-cent put went all the way up to $3 in about, 10 minutes. So this is that exponential gains that people love, because if you bought just one call or one put at 50 cents, that would cost $50. Because remember, One contract equals 100 shares. So when you're buying one contract, even though it says 50 cents, you're actually paying for 100 shares at 50 cents. So it's going to cost you $50. So if you buy it at $50 in 10 minutes, that same put would cost $3, and you could have traded that off and made, $250 in 10 minutes.
So the prices that I'm seeing there, is that the actual price per contract on that, or is that?
Yeah. Yep. So the one on the left, this is the $950 strike price call, and the one on the right is the $925 put call put for that strike. Does that make sense?
Yeah.
So one, the call actually went down to 0, whereas the call went all the way down, all the way up to over $3 at one point. But then as it approached end of day, look at the bell, it went from $3 down to 1 because time depreciation. Everybody's scrambling to get out of this, trying to sell their put, even though it was like in the money. They're trying to get out of that one as quickly as possible, because as soon as it expires, this is worthless and nobody wants it. And that's what happens to most of them. They all expire worthless because nobody actually wants to buy 100 shares of Tesla at $925, because that's, nobody's got $92,000. All the day traders, they're just wanting to pass the briefcase off to somebody else.
So
that's all they're
does
trying
that
to
mean
do.
if it expires that you are basically forced to buy in the stock at the price that it's currently trading?
Oh, no, you're not forced to buy it. You just lose all your money.
Okay.
You can't get it back. So if you bought 10 contracts, or even just one, right? So if you bought the one contract at 50 cents and you paid $50 for this one contract, maybe you were up $300 and you're excited about that, but you never sold because you're kind of new, you don't know better. And so you just hold on to it thinking something could happen. As soon as the bell rings, this contract's expired and it's no good anymore. So you just lose your money.
Is this a daily expiration or is this a weekly expiration?
This is a weekly.
So is this was yesterday, Friday, right?
Yep, this was yesterday's.
So that's why the time decay happened so rapidly, because even though it's a weekly, you bought it on the same day. Let's say hypothetically you bought either one of them on the same day, and because it closes at the end of the day, the contract is worthless. The next weekly, you start the next week. Okay, that makes sense.
Yep, exactly.
Now, why would a person want to buy Tesla at $930 when they could potentially buy a call option for 50 cents, or even a put option for 50 cents? Like, why would the prices be so dramatically different? Well,
and that's because, let me go back to the other screen real quick. Okay, we're back on Tesla on E-Trade Pro, right?
Mm-hmm.
Okay, so it was only at 50 cents because it was 10 minutes away from closing bell. So every week starts out Tesla the same, right? So right now, the 925 strike, and it's currently at $926, right? So
yeah,
it's technically in the money, but right now that call option is worth $29. And again, at 100 shares per contract, that would actually cost you $2,915. Whenever I buy a call or a strike, and just put this out there, because it is a little confusing in the beginning. Whenever you buy a call or a strike, if you buy one call or one put, just take that decimal and move it over 2 spots. That's what you're actually paying for it, because it represents 100 shares. So if it's a $29 call, it's actually $2,900. So even though it was only trading at 50 cents on Friday, today's option call is a new option week. So it just starts all over again every week. So the same option that expires next week is actually worth $42, right? So like they increase, again, it goes back to they increase in value the further out you get.
Yeah.
Or the cost is more. It's not that they increase in value, it's just that the cost is more. And so what's happening on this call option, where it's going up in price, is also going on here, right? So on the 18th, they're both going up, they're just different prices, and maybe you can afford more. Like if you're, again, it goes back to, a day trader with a small account, even at $26, I can't afford that. So you can trade up and down as far away as you want, and let's say I'll just show you how I typically trade Tesla, right? So I'm not going to buy a $26 call or put, at least not anytime soon. So I'm also not going to trade something that's so far away from the strike price that it's impossible for it to get to. But I want to trade a reasonably cost call or a put. So I'll scroll either up and down, and let's say, yeah, I'm looking at this chart. I'm thinking, it could be bullish, right? It could have a breakout on Monday. So I think it's going to go up in price on Monday. So I'm going to be looking at this option chain as something I want to afford. So we could either go with like the $950 strike, which is trading at 18, or maybe I think 975, right? Because I'm thinking of key levels, whether that's you got 900, 950, 1,000, but you could say 975. You could look at the chart, see those key technical areas, right? So 925 is a key technical area. 1,000 is a key technical area. I'm sure if you broke down between 925 and 1,000, you'd see that 950, 975. Those are probably key technical areas too. So when I'm buying my call or my put, I look at those key technical areas. I also look over here to see the total volume, because I want something that's liquid, that's trading with a lot of traders, because I want volatility. I don't want to buy a call or put on Tesla that's got 60 people buying it in the day, because that means you're only trading with like potentially 6-7 other people, and that's it. I want to trade something that's got a lot of volume to it. So like $1,000 has a ton of volume. So this has a lot of volatility in it.
Mm-hmm. So the volatility that's actually on this stock is not the same as the volatility that's in the options market. So if you're looking at a specific price, because one of the questions I have is like looking down at the options chain, why would a person pay a higher price when you can just scroll down and get for a cheaper price?
And that's what they do.
Like 440.
Yep, so, that's what you would do, but you would want to look at something that's got a lot of volume to it, so that because obviously if you got a lot of volume, that's a key level. That's probably going to be a key level, and $1,000 is. So, and it's cheaper, right? So people are going to trade what they feel they can afford, and it goes back to what I had said earlier. If I'm buying a call or a put just because of the volatility of options, if I buy it, I'm buying it with the notion that I'm going to lose it all. Now, I'm not saying I will, because I have risk management, right? And I don't like to lose at best more than 10%. And I don't even like losing that. But it all depends on, other things, technical indicators and technical levels, things like that. But at $6, I can afford that. A lot of people can afford that. That $6 call option is $600. And I know that, since one contract represents 100 shares, that if it goes up $1 to $7, then I've made $100 on it, right? And that's, you got these goals in mind, right? So let's talk about that for a second. And if you think that this 900, it's at $925 now, more or less, you think it could get up to 950. As a day trader, I don't care if it gets to 1,000. That's great if it does, but I mean, that's, and it's Tesla, so who knows? It could go up $75 in a day. But if my goal is that I want to buy it at this level, I want to get out at 950, because since that's a technical level, it'll probably, hit it and then come back down and dip in price. So I just want to get out at 950, maybe 949, just to protect myself. What I would do is $50, $950 is $25 away from where it is now, right? I would look on this at $1,000 and I back it off by $25. And I see that at 975, the 975 strike is going for $10.75 on the ask side. So that would be my goal. I would get into a $1,000 call on Tesla at $6 with a goal of getting to $10.75 by the time it reaches $950, and then I would get out. That's how I put my price goals. I just kind of back off the level that I think it's going to get to. Does that make sense?
So is that, when you're doing that, that's not based off of what the Tesla chart is? That's based off of what you're showing me with the other ones, the time decay, right?
Yeah, I mean, you got to take time decay into effect, but if you're trading Tesla on an intraday, and especially on Monday or Tuesday, there's some time decay, but if it is volatile like it is here on a Monday, it's not going to lose that much value on Monday. Tuesday, like if you hold it, let's say, it's at this level today where it came down to $926. And then on Tuesday morning, you're going to see that this $10.75, if it's trading flat for the first, let's say, hour, you'll see that 10.75 kind of back down. And it'll probably come down to like about $9 if it trades completely flat for the first hour. You're going to see time decay, even though it's never left 926. Theoretically, if it stayed 926 for 1 hour solid, you're going to see time decay occur on that because it's not going anywhere. The less volatile it is, the more that time decay depreciates it.
Okay, so I guess my question is when you're buying it, let's say it's 610, how do you know when it's reaching that 1075 mark? Like, how do you know that that's
because you're trading it along with, right? So you're wanting it to get to $950. Let's say it has a breakout. Let me pull up the chart on this particular one. We'll use this as an example. So we know on this $1,000 strike on Friday, when it got to $935, it was trading above 8, right? So we know that if Tesla comes back up to $935, it'll already be at $8 because that's what it traded at on Friday. And it's not going to lose that much time decay between Monday and Friday. It'll lose some, so it may be down like $7 or something like that. But this is generally the zone on Monday if it gets back up to $935 that the $1,000 call is going to be trading at. And then if it gets to $950, it's just going to be trading up this chart, and you're just going to be following it along. Every pullback, it's going to pull back the same. Like you can see, like it's a direct reflection, right? You got this head and shoulders that occurred at the end of the day on Friday on the actual stock of Tesla. And you're looking at the call, it had the exact same pattern. So it's just going to be going up in correlation to the actual underlying value of that stock.
So I guess a way to think about it is when you're buying the option, the chart that you're looking at is the option's value. It's not, it's kind of like how an ETF will actually follow the main stock of where the stock price, let's say DWOC versus DWOCW, it's just another way to actually trade the same thing.
Yeah, that's perfect. Yeah, that's exactly the same. The way the warrant trades with the stock is the same way an option trades with its underlying stock.
Okay. And so when you're trading the options, are you looking at I'm assuming you're looking at both the main stock, but are you also looking at the options chart versus the actual stock chart? Or how do you determine, because I know with warrants, sometimes the patterns or stuff like that are sometimes cleaner, sometimes they look different.
Yeah. So I mean, sometimes I do, but most of the time I don't. I've never been tied to an options chart, to be honest, because I'm just looking at this, right? I see, like, if I'm buying this on Monday, I buy it at $6 and I think that's going to go to $950. I'm just watching in correlation to this. I know in my head that I'm waiting for it to get to $950 because it'll be about $10.25, the same that, I hope I made that clear on how I got that, goal in mind. If I think it's going to get to 950, that it's going to get to 1075, I'm just kind of like watching the price go up as the stock goes up. And on Monday and Tuesday, it's generally stable. It's that time decay. The closer you get to the expiration date, that's where you start getting a little concerned. And, if I'm trying to buy an option that I think has a bigger move, that I want some continuation, and maybe I'm going to stay in it over the weekend, I'm not going to be I'm definitely going to be buying the next week's option, even if I think there's a potential. Come Wednesday, Thursday, I'm buying into next week's option chain just because I want the ability to be in something that's not going to have significant time decay. And sometimes I'll even go as far as 3 weeks out if they're cheap enough. Tesla's a bad one just because it's so expensive. But let's look at Micron is a really good stock. I've traded it several times. very inexpensive, right? And this is the kind that when it has a powerful move, it can go up in price very quickly. But if you're looking at it, you've got, I'm back on the February 11th option chain, right? The one that expires this coming Friday. Well, at $81, it's trading at $2. So it's a very cheap stock, and it's a good stock. It's semiconductor. I say it's a good stock. It's an easy stock to trade because it's got very basic trend lines that you can follow and technical patterns that just make it like, look at this. This is perfect. Right now it's in consolidation, but it's at the bottom of the range for consolidation, right? So you could look at this and assume, this is probably going to go back up, to hit the top. If it doesn't, it's going to be a breakdown. Mm-hmm. It's that easy of a chart to read. So, and so that kind of determines how you look at it, and if there's news or something that comes out. But the key is it's cheap. It's $2. So I could buy one call on this and it's $2, or I could buy 10. And if it goes up 10 cents, then I've made $100. And if it gets up to, I think it traded as high as 85, right? Yeah. So if it gets up to $85, so if I buy it at $2.14, I think it's going to go up $4. I just back off. So $1, $2, $1, $2, $3, $4, right? So if it gets to $85, that's going to be worth $4.95. So, you've more than doubled your money on that, if that's what you think it's going to do. And again, if, there's some time decay and you kind of got to be, you've just got to have good risk management. Again, have your loss plan in mind so that if it goes under, I don't like losing. If I bought one of these, I wouldn't want to lose more than $10 because then it breaks my trade plan, right? I want to be in the money, and I'm a very impatient trader. so as soon as it starts going against me, I'm out. I don't even look back. I'm like, oh, it didn't do what I wanted it to do. I'm out, and I'm only out $10.
So another question is, with the bid and the ask, can you bring up that options chart that you're showing me earlier?
For which one?
For this one right here.
Micron?
Yeah, for this exact.
Oh, okay. Yeah, for $81. Yeah, let's see. Yeah. Okay.
Yeah. So let's say with this right here, the prices that, just to try to, for myself and for the viewers and stuff, the bid and ask price, that's basically like what you'd be seeing on a normal stock chart, right? So when you're buying that, if it's, $81 and that currently translates to around $214, if you go to buy something at $4 and you get a fill, you're instantly getting me down, right?
Can you say that again?
Yeah. So like if you're looking at this chart where your peak mouse is at, down there where that 214 is, that's where it closed. So if you're buying that 214, but let's say on this options chain over to where it says a bid and the ask, if you buy it, let's say 414 right there, if you get a fill, it's automatically you're gonna be negative, right?
If I bought it at 214.
No. So it's currently at 214. Let's say you accidentally clicked on it and you bought it at 415 where it says the ask.
Oh, up here?
Right there. Yeah. So
no.
You bought it there. Is it going to be more like a limit order if it won't buy that unless it reaches that price? I'm assuming the price that it's based off of is this options chart down here versus just, because that's one of the things that's confusing is, there's so many different options to buy. When you click on one of those to buy it, how do you know which ones you're supposed to buy? That type of a situation.
So if I'm looking at this one, I'm anticipating that's going to go up. There's a couple of rules of thumb. People have different thoughts. Generally, I like to buy out of the money, right? So if I think it's going to go up to $85, I'm probably going to be buying, where am I at? Yeah, I'll probably buy the 82 one. It's a little bit cheaper. It's got a little more volume to it. So I'm probably going to buy the $82 calls. Once you buy this, and let me just run through that. That's a good question on how to actually buy it, right? So I think it's going to get to $85. That's my trade plan. I'm trying to get a double top, right? That's all I want. I don't care if it goes through it and gets 90. I'm going to be safe. Let me say, and I may sell half of my shares at $85 if I buy 10, right? So let's say I buy 10 calls at $82. That's just barely out of the money. As it goes up towards $85, it hits 82. The $82 strike becomes in the money. Now that kind of stabilizes that price. Once it's in the money, it stabilizes it a little bit better because it's got intrinsic value now because it's in the money. So that price is going to keep going up, and it finally hits $85 when the underlying stock hits $85. When it hits $85, it should be worth about what $78 is worth now while it's at 81 bucks. So $82 will now say $4 on the bid side, $4.15 on the ask side, and that's just hypothetical. Now, when you go to sell it, so when I go to buy it, let's just say I buy it at $1.65. I double click on the ask side. It comes down and fills out my little order form. Maybe I want to buy 10, you can change that to say one contract. I'm going to leave it at 10 for right now. I'm buying 10 contracts of calls on the February 11th expiration with an $82 strike price. This is the bid and ask. I put in my limit order. I want to, I'm buying it. So if I put in $1.65, I'm going to get filled because it's on the ask side. If I put in $1.60, it's going to be like any stock. If you put in a bid at $1.60 on a penny stock, you could sit there for a couple minutes, or it could, fill right away. You don't know, but like if you want in it, you think it's going to make an immediate move, just jump on the ask side. Now you get filled, right? So now you have 10 contracts at $82. 10 contracts times $1.65. 10 contracts each has 100 shares in it. So really what you're looking at is $165 times 10. So that would be $1,650 that you bought. It goes up in price. This is now $4.15, where it says $1.65. As it's going up to $85 on the underlying stock, it gets it increases in value, and you'll see all of these numbers will be increasing in value. So the closer you get to 85, this will probably become around $4. And now you want to sell it, but you don't care. You just want out because it made $4, right? So you can just double click on the bid, and it'll pre-fill all of this out, and you just say sell to close. So you buy to open. I forgot to say that in the beginning. When you buy it, click on the ask, pre-fills all this out. You hit buy to open. That's just buying it, and like you would a normal stock. And then when you go to sell it, you double click the ask price or the bid price. You want out of it right away, so you double click on the bid price and you sell to close. That's important. That took me forever to figure out. That's why I didn't actually trade options for a long time, because I was like, what is the difference between all of these, right? Yeah. And again, I'm just doing calls and puts, and I'm keeping it simple because it gets more complicated on the other ones, like spreads and things. When you buy to open, that's just buying a contract. When you sell to close, you're selling that contract. Conversely, if you want to short a call, instead of buying to open, you would sell to open. Just like short selling, you're actually, you have your shares to short and you sell it right off the bat. That's what you're doing. When you're selling a contract to open, you're shorting it. And then you buy to close out your position. So these are short seller buttons right here. Avoid these buttons if you don't like shorting.
And so if you're going to be buying a put option, you're going to also be still using the buy to open and the close.
Yep, exactly.
Okay.
Yep. So if you want to, conversely, if you think that this is going to drop back down and test $77, again, I'm going to buy out of the money. So let's see, it's at $81 now. So at $81, I'm probably just buying the $80 strike on the puts. And same thing, $1.53. I want 10 contracts for the February 11th, and I buy to open. And then when I go to sell, and if it gets down to $77, same methodology, right? You just back off, what is that? 71 is about $3.50, right? So 1, 2, 3. If it gets down to $70 or 77, it'll probably be worth around $3.
Okay.
So I would just put in my little, sell price at $3 and hit sell to close. And that's why it's considered a long, because you're buying the put.
Okay, that makes sense. And so is the strike price, it looks like the strike price is translating to the underlying stock value, right?
Yeah,
Okay.
the strike price is just where you can buy any strike price you want. And that's kind of like, it's like roulette. That's the number you think it's going to get to at the end of the day, and that's just based on your own trade plan. And, that trade plan can be based off of breaking news. It could be based off of technical indicators, Peloton, for instance. Let's look at, I'm going to show you one trade I did last week or a week before. On Peloton, where are you at? Oh, I didn't do Peloton. I traded AFRM. So you had Peloton had breaking news last week, and it's not often I've got breaking news on stocks to trade, right? But I very rarely have it up, and I'm very rarely looking at it. I just happened to look at it right as they posted something about Peloton announces they're no longer making bicycles. And whether that news was right or wrong, that's what came out. And automatically everybody goes, oh, short Peloton, right? Mm-hmm. So when that happened, I went straight over to the options to look at it, but Peloton was already halted. Well, breaking news also put it out, AFRM is a sympathy to Peloton because they do the financial backing on Peloton. So I went to AFRM because since Peloton is halted, everybody still wants to make money. So everybody went to AFRM. Mm-hmm. And sure enough, it started breaking down. And this somewhere in here is where the news came out. And so at 12:53, I only bought 2 contracts, but I bought 2 put contracts on AFRM. I bought the $65 put on the 20 January weekly, which was that current week. And within 2 minutes, it had dropped down from 60, it was trading at like around $66, and it dropped all the way down to 62.79. And that's where I got out. So in about 3 minutes, I made $1.50 per contract. So that turned into a $300 gain in 3 minutes. It's unbelievable. And so that's, let me go back to the option train.
So the 65 put, is that how much, so is the 65 put, is that how much the contract was, like 65 times 100, and you bought 2 of those, so it's 200?
So, yeah. So I went with the strike price. At the time, it was trading at $66, right? So, and I've got the option chain up. I'll just put, even though there's no correlation right now, but there's a chart on AFRM. So it was trading at $66. I wanted to put, because I wanted, I thought it was going to go down. I had no idea how far it was going to go down. 65 is a key level. So I thought it can at least get to 65. It blew through 65. That's beside the point. As soon as I was looking at it, there's a little bounce on 66. I bought the $65 on the bid price. And I just had, my 2 little contracts, buy to open very quickly, and got filled very quickly. And then it cracked right at that moment. Yeah. So I kind of got lucky at the same time. Now I'm in the $65 strike. It's trading at $62 now. I'm still in the $65 strike, but within a minute, this had jumped from, like, in this case, looking at this option chain, it went from like $8 to $10 in just a minute. Yeah. And that was it. Now I'm not trading the $62. I'm still trading, like, if you go over here, and you're going to see what I'm trading right now. But if you go over to like your dashboard real quick, it'll show you what you're in, and you can just trade from that. So you could like click on the option here to trade out of it. You just trade and come back over here. So that's one way to get out of it, or I just stay on the screen because I know I'm in. So you're just clicking on this and it'll automatically fill in all the data, and you just sell to close.
Okay, so when people say that I bought, let's say the 65, they're not talking about the actual price they paid for. They're just talking about the strike price they're in.
Yep. That's all they're talking about. They're just talking about the strike price. You're buying 2 contracts of $65 puts. Okay. And so when you try to trade out of it, you have to trade the $65 again to get out of it. And what will happen is, like, since I like doing the automatic fill button, right? So when you're in it, like, it pre-fills this to 10 contracts every time. But if I just bought 2 contracts like I did, and I'm in it, when I go back to sell it and I double click this will automatically fill to $2 on eTrade Pro. It'll automatically fill to two contracts.
Okay.
So you'll know.
And so with the when you're
And you
trading,
and you and you won't be able to sell anything else. So let's say you got the $65 puts, and then you go to sell it and you click on $64 puts instead by accident, and you go to sell it close, it'll just kick it back. It'll say you can't sell this, you ain't got it. So there's
okay.
nothing to sell.
Okay, so just to make sure that I'm understanding before we continue on, with the option spread, with the options chain, you can technically buy any chain on there.
Mhm.
It doesn't matter. And does that mean you'll
Yeah,
instantly get a feel on everything, or just like a limit order, you may have to wait a little bit? But it's not determined
no,
based off the actual price of the
it did,
underlying stock.
it,
It's based off of who's willing to buy it, the option of that price.
yeah, I mean, you can buy any one of these strikes. Like
Mhm.
if you're looking at all of these, every one of these has its own chart. The $68 call, $68 put, each one of these is its own chart.
Okay.
And so you can buy any one of them for any expiration period. Every one of these replicates what's in this option chain, but for a different time period. So
Yeah.
every one of these is a completely novel chart that relates to the underlying stock.
Okay.
And you can trade any one of them.
And so the open interest, is that how many, I guess you can say,
Well, that's the
people?
key. That's
Yeah.
the key, right? So you got the total volume and and this is why I like the E-Trade Pro, because it's got all of this really easy to understand. You got the calls and the puts on the left and the right. I like that you're seeing that on AFRM on Friday, obviously it was green on the day. So you had everybody was making money on the call side. Nobody was making money on the put side. And you can also see that in the volume, right? Because on the call side, look at all that volume on the $63, you had a lot of interest, but there's only 561 people who actually traded it. So I'm going with the one that has, the most volume to it, which is 65, which isn't a surprise because that's a key level. So more people were trading the $65 level than most of the other ones. Yeah. So I'm going to go with the one that's got the most liquidity because that's the one that's going to be able to get you the feels better. This one over here that only has 7 people traded it, I'm not getting into that one. That's ridiculous. And I have done that, and it's extremely hard to get out. Yeah, I can show you what that looks like. Let me flip over. I traded, I was trading a long trade, and it actually worked out. I cut my losses on it, but it's a success and a failure at the same time. So if you're going to do a swing trade on an option, which you can do, there's always time decay, right? So I was looking at CarMax, which has only monthly options on it. And on I think it only has monthly. At any rate, I was only trading the monthlies. I saw this trend line, and I love that trend line because you're seeing the little pops, comes down, pops, comes down. And that is like a standard. This is hedge funds that are selling out of their position because this company, for whatever reason, they had a really good run up through the holidays. Traveling's all over. Omicron started. They're not making as much money, or whatever CarMax does. Inflation, right? Inflation. People aren't going to be getting the loans, so hedge funds are trying to get out of their positions. This is a very hedge fundish type trend line, and so you can kind of go with that and say CarMax is kind of done for right now, right? And when there was that pop, the only problem is this is when the entire market sold off. So, is it good? Is it bad? I liked it because you had the 300 MA is somewhere in here and it's trading below it. It's a pretty safe bet that this is going to go down some more. So when this popped up, this little key area, which is about $112, that's a key technical level for this. So you could buy some monthly options on CarMax. That's what I did. I bought some monthly options, but I got a little too gung ho, and I bought them at like around $109. And so even though my trade plan said 112, I just wanted exposure. I got in and I paid the price because CarMax, if you're looking at, this is the chart I bought for the $100 put because that's where I thought it was going to come back to. And I know that when it's trading at $105, at least when I bought this was about 2 weeks ago, the $105 strike price was trading at, or when the price of CarMax came down to $105, the $100 strike price was trading at around $3. So my goal was to buy it at 110-ish, maybe average down as it gets to 112, and then sell at 105, because you can buy the puts, the $100 puts, for about $1 or 70 cents when it gets to around 112 bucks.
Mhm.
So you're looking at about 200% gain if it gets back down to 105. Well, if you look at the chart, sure enough, that's kind of what I did on February 1st, 2nd. It's trading extremely low volume. And then when it came down and touched 205, it got all the way up to $2.25. I think it got down, like, this is like around 70 cents in here that you could have bought the $100 strikes.
Yeah.
Unfortunately, what you're not seeing before this, I got out way ahead. It was a little bit more volatile, before February 1st. And then it had this big pop, and that's where I got scared out. So my plan, I thought it was going to come back down here. Instead, it popped back up and cut my losses. Eventually, it made the goal. But I wanted to highlight this because this is one that's got very little volume, and it's really hard to get out when it's really little volume. I will show you what happened on CarMax and why it was a bad trade. I mean, it was a good trade, but you had to be patient. Look at this volume. It's like sucky. The put volume is awful on it. And I had this trade plan because I researched this over the weekend, right? And I was like, oh, I'll just get the $100 strikes when it gets up to $110. And so I did. I bought some. This is actually pretty good. It's got 87 people bought it. The day I bought it, there was 20 people. And by the time I bought it, I was like, oh crap. Now look at the spread on this now, right? It's $1.30 and $2.10. That's pretty much how it looks all the time. So sometimes, like, you really want a volatile stock that's got a lot of volume. Otherwise, you're going to have a wide spread, and it's really hard to figure out where to get in at. And what you kind of wind up doing, like if you really want in it for whatever reason, you kind of have to guess what that price is that you want and what's fair. Kind of like going to a flea market or something. What's a fair value of the option? And you go to the chart and you look at it, wherever it's trading at that particular time. And like if it's showing this $1.30 and $2.10 spread, you're like, let me go with the $1.50. Maybe you get filled, maybe you don't. Somebody got a really good fill there, around $1.60. They probably traded out of it right here at $2 or something, somewhere in here. They probably traded out of it. Maybe they're still in it, but I mean, it's just light volume. It's really hard to trade on these. And then there's some, so that kind of goes to one, there's a ton of things I could talk about, but
so like with
every stock is a little different. Tesla, huge amount of volume on it.
Yeah.
And there's others that have good volume, like Airbnb. It's just that you need to know actually, let me do this one better. BNTX. You really kind of have to know how that particular option chain for that particular stock trades, because on BNTX, which was a really good, trade over here, was overextended at $450. You got this huge gap down, right? I mean, it just went from 350 all the way down to, what is that, 250. Great gain in the options. The problem is that when you're on that particular stock, you have to know that you need to buy into, like if you're betting against it and you're buying puts for the downside, you don't want to buy it as it's coming down, like even as it's breaking key technical levels, because the spreads are horrible and you'll get filled at $8.70. Well, that's where they're selling to you, and now you're the stucky with something that's going to bounce up, and now this is only going to be worth like $7 at this point at the same level. So on some of these options, like you really have to know what you're trading, because I just happen to know on BNTX, Nvidia used to be the same when it was $1,000. Airbnb, if you think it's going to be coming down, you have to buy into a spike on the bid side. Otherwise, you're going to get stuck with a horrible, position, a horrible price on your position that you're going to wind up just selling for a loss, or at best break even. So you really kind of have to know some of these individual stocks, but that's because the liquidity is just not there. So you really want to buy, if you're looking into options, you want to buy something that's got a lot of liquidity, look at the volume, make sure that it's, got a volatile. This isn't very volatile on this stage. It's kind of traded sideways all day. So you want something that's got news, and that kind of goes into the different setups. Like if you're a swing trader, like if you want to get into options because you can make exponential money on it, right?
Yeah.
You can do a swing trade and do something like I was doing with CarMax, where you're looking at the overall pattern, like Tesla, it's going to go to 2000 by the end of next year. CarMax is probably going to break 100 within the next month. So you just got to be patient, wait for some pops that you buy into a put on, or if it's down, but you think it's going to go back up, wait for some dips to buy into those dips for calls, same thing, and follow that trend line. Or, you got all your different setups. You have the breaking news one, like with Peloton. I'm a very impatient trader, like I said before. I like doing a lot of scalping, like with Tesla, when they're about to break a key technical level. It's safe to, buy some, if it's going to break a key technical level or it's going to pop and, squeeze really quickly, I'll buy that technical breakout for a real quick gain and just get out. That's all I want. I don't want to stay in it very long. I just want to get that one little technical breakout, make my 100. With Tesla, you can make $100 in a second and then just get out of it and not even look back. That's kind of what I do. I don't want to risk a lot of money. So I'll buy, like if it's like that one that we were looking at, I might buy a $6, $1,000 strike and just ride it for $1. It'll go up to $7 and I'm out.
So to help clarify, the open interest, is that how many people actually owns a contract? And then the volume is basically like any other like stock ticker volume. It's more of how many people that own that contract are trading it within each other. Because it sounds like, and correct me if I'm wrong, that because each strike price is basically its own chart, that means that the volume is based off of that strike price, and the open interest is basically how many people's interested at that price. Is that right?
Yeah, that sounds right. I'll be honest, I don't know exactly what the open interest is. In my head, the way you said it, that's exactly what I believe, but I've never researched it. I look at the volume part because that's the most important part. Like open interest to me, I'm like, is that good? Is that bad? Is that somebody who's got a lot of bids, stacked up, or a lot of, they're selling? Yeah. I don't know, but I do know the volume, and I'm watching those technical levels. That's the more important part to me.
Okay. And it kind of makes sense of why a person can make thousands of percent on options, because like looking at Facebook where it closed out the day before the crack, and all the way down, it was only an 89%, all the way down to the bottom on the first day it happened. But because each chart is different and it's kind of like a warrant, that percent of, if you're buying it, let's say $13, and let's say it goes down to $1, that's a huge move.
Yeah, let's just go.
So much up of an aspect of that.
Yeah, let's look at and actually, I know Hold My Text, and he actually traded Facebook the next day, and he made a good gain right out the door. You can. There is a trade there. It depends on how you like to trade, but I know a lot of people use like 5-minute candles, right? So in the morning, as it opens up, is it going to, try to break out and make its gains back like we've seen on some, like, what was that, Starbucks the other night, right? Those shorts just got hammered in after hours on Starbucks. But on this one, you see on the first, let's pull up the 5-minute candle. This is how a lot of people like to look at them. So you got the high of day is set in pre-market, right? Up here at about 252. It can even get up to 250, right? So there's your trade right there. It tries to go up, it just can't. So by the time it comes back down to 245, there's your entry and drops down. Great trade if you can do that. And I think that's where Hold My Texan did. He just took a real quick move and got out of it. But if you look at this option chain for this week,
because that right there is only like a 5% move. And the way that I trade, I'm typically taking 15, 20, 30, 40%. And with options, that's one of the reasons why I was curious about is how are people making hundreds or thousands of percent move by gains on a chart that's only moving 2%?
So this is what the $250 put looked like on the 3rd. It was only trading at, oh my God, what is that? It's like nothing.
It's like a few pennies.
Yeah.
maybe a few cents,
Yeah,
something like
because
that. It's cheap.
nobody is so far out of the money. Nobody thought it would get to 250. So yeah, you're talking less than $1, and here it is. The next day trading at whatever $15, like
Yeah.
15,000 or whatever that is. That's a lot.
Yeah.
If you bought one call or one put on that, that's a good payday.
Yeah.
Like nobody would expect that though, right? So
No.
more likely this is what would have happened. I've traded in and out for Facebook. It's one of the ones I love to hate. I would have maybe, if I was going to do a YOLO trade on it. And I don't like doing YOLO trades. I did on Tesla. I ain't gonna lie. I tried on Tesla on Friday because I actually thought it was going to break out, but I lost like $20 on it. And that's the key on YOLO trades, right? People do YOLO trades. If you did a YOLO trade on Facebook, whatever you go in with, just go in with, you are definitely going to lose 100% by the end of the day.
Yeah.
Right. So I like doing that. If I do a YOLO trade, it's when it's got a ton of volume like Tesla did on Friday I won't even say they didn't have a ton of volume, but they had good volume, key technical level. You think there's going to be a move. And if you're green on the day, right? So I think on Friday, I didn't make a lot. I made like $300. So I took like a $50 position. And I said, I'm good with losing all of it. And as soon as it turned and I saw I wasn't going to make it, I sold it and made back, I lost like $25 on it. And I'm good with that. I knew I was going into something that I could lose 50. That's a YOLO trade. Don't ever go into a YOLO trade with way too much size. You go into a YOLO trade with a small size on something in case it works out. This guy, whoever bought the $300 put on that day, I mean, that was probably trading around $5 or more, maybe $5, $6.
Mm-hmm.
And look at that. It got up to $50
Yeah.
the next day. And that move is done, right? So the next day, it traded up a little bit more, but you're right. Like it looks like it went from $55 to $60. And again, we're looking at the $300 strike price. So it gained a ton of value overnight. And now as we're going along though, you got time decay is probably happening. I was going to say it's probably getting lower, but it looks like it actually increased in value. But the volume's dried up because the opposite is now in effect. Nobody wants this $300 call because everybody knows it's not going to get there anytime soon. So the volume is down to nothing now.
Yeah.
Whereas on this day, a ton of volume. So there's a difference. Now it'll be hard to get any kind of fill on it except to sell your position because you can get out of it. But if there's not a really good trade on this one now anymore.
Yeah. So with what you're looking at here with Facebook, I'm assuming that the bid and ask down there at 27 cents and 29 cents is also Facebook. So on mine, because I'm looking at, that's like way out of money. And you're talking about the volume is something that you want to make sure that you're looking at. So the volume on, let's say the 25 or the 27 ask on the call side.
For which?
300 strike.
Okay. Yeah.
So that right there. So the volume is 17,000, and I'm seeing it here also in 17,000. But like, I guess again, like just to clarify, why would you want to buy that when you can buy something that's closer to in the money? So I'm assuming that in the money means that you're close to actually being in profit.
Yeah. This 17,000, I don't know who this is. I've never. What is it? Yeah, so that's on Facebook calls. That's insane. I don't know why you're saying all that volume on the $300 calls. Maybe they were all YOLO. That's probably it. They were probably doing YOLO trades on Friday.
Okay.
Something. Yeah, and again, they're cheap, right? So $25 or 25 cents, which it's 100 shares. So that turns out to be a $25 trade. And people will do this because if Facebook, so a lot of people were thinking Facebook on Friday was going to go up to $250, right? So even though it's so far out of the money, that's impossible to get to 300. It could, if it cracked 250 on Friday, you would probably get a squeeze because there's so many people who are short in this. And what you would see is this 25 cents would probably go to 50 cents. Or, that's what they're hoping for anyways, right? So they're hoping it goes up $20. So let's back off $20 from 300. Yeah, they're hoping it'll go to 50 cents. Well, that's 100%.
Mm-hmm.
So you've probably got 17,000 people YOLOing, hoping for 100% gain at the end of the day
Okay.
on a 25-cent stock. I don't like it. Again, that's a gamble bet. I generally, I don't like doing that. That's so far out of the money that it's not even worth it.
So that's what I'm saying. So when you're trading the options, you don't want to just randomly pick a strike price and
No,
bid and ask. You want to stay as close to the money as you
you
can.
do.
Okay.
And if you're doing a swing, that you want to actually, my advice would be that you want to probably buy in the money. So like, you know, let's say that CarMax example, right? I was buying way out of the money. The safer bet for me would have actually been to have bought $110 put, because it's a little safer. It's going to take a little more time, but now it's a little more stable with its intrinsic value. So if you're buying for a swing or a longer duration option, you want to buy within like whatever it's trading at in the money. If you're looking for a good intraday trade, I always like to buy just barely out of the money. I'm never going to do something that's like, well, I say just out of the money, but like if we're looking on, Facebook for next week, again, let's go with the most volume, and it's going to be those key technical levels. So if I'm trading Facebook on Monday, I'm going to be trading the $250 calls because it's got 46,000 volume. Or conversely, I'm going to be, trading probably 230, maybe the $230 puts if I think it's going to go down, which I don't. But that's how I'm doing it. I'm just looking at the volume. I'm looking at something reasonable that's just out of the money. I'm not doing a $280 strike. That's for gamblers. I'm going to do something that's reasonable that I think it can go to, and even if it doesn't get there, maybe I don't care if it gets to 250. At this point, as I'm looking at the Facebook chart, the way I would trade it, I think it might get back to 242. So I'm looking, it's at, essentially $238 now. I want it to get to 242, so that's $4. And again, I'd back off on this, about $4. So at $2.81, the $250 call strike string at $2.81, backing off, it might be able to get to about 375. So that's my goal, is 375 on this. Does that make sense? Because I'm backing off. I'm looking at what's the next, going back $4. It looks like it's somewhere in between 345 and $4. So I'm gonna just take the meat of the move. I'm going to 242 for a double top because that's possible.
Yeah.
Does it break the double top? Maybe. And maybe I'll buy 10 calls and sell half of them at 242. There'll probably be a little pullback and push through, and then I'll sell the rest at 245, or maybe another quarter at 245, and then fully out if it gets to 250. That's how I would trade that.
Yeah. Okay. And how do you actually handle risk management on an options trade? So, well, as you know, the way that I trade, I use bracket orders, so that way I'm not actually in control of my trading. Right. It sounds like with the way that you're trading is more discretionary, that you're having to base everything off of the decision. So one of the charts that you showed before, I don't remember what the actual ticker was. I think it was the one that you thought was going down, but you kind of got scared at. What was that? BNTX, I think it was.
Oh no, yeah, KMX, yeah.
KMX, yeah.
Yeah, CarMax.
Yeah. So like if you're trading that one, my assumption is that as it was going down in the daily time frame, you were trying to buy it as close to the top to try to risk a breakout. And then as it was coming down, so if you were to buy that, let's say at 110 strike, and it's going down, as long as it doesn't go above that 112, wouldn't you want to hold on to that? Like,
you hit it. That was it. All right, you hit my trade plan. That was it. Like I bought into it. I said if it breaks 112, I'm out, or 112.50. Actually, I think I said 113, to be honest. I wanted to give myself some room. Okay. It never hit my risk, and yet I got out. It was dumb, but I mean, it was a very choppy market. Yeah. And I'm thinking, so I bought, this is about a week and a half ago that I bought these particular puts, and I bought them expiring on February 18th, which is next week now, right? So I'm looking at time decay, and it is affecting the position I'm in, and I was having to average down and you just had all this chop happening in here. And I'm looking at the chart now, I'm like, it's a perfect head and shoulders chart. But when you're in it and you've got the cues are starting to, the NASDAQ is coming back, then every day is like, oh, AMD is like really strong today, and then the next day it's like, oh, Facebook is down. It's been like that now for a week and a half. And there was just this point that it's just mentally taxing on a person who's impatient like me, that the move was not happening. And so it got to, I think it was on this day, I think it was the 26th, that I was like, I am done with this. Or maybe it was the 20th. I don't know, it was one of these days. It was probably this day. Honestly, because I finally worked on it. But there was just this bounce where I was like, oh my God, here we go again. I've been in this play forever now. I had been in it since I think the 20th. I don't know, it was just a bunch of, no, I got in it on this day. I got in on the 24th. For me, 3 days is a really long time. And it was one of these pops in here. It was probably this morning one that I was like, I'm done. I'm out of it. I don't trust it anymore. So I'm positive I got out on the 27th. And no, it didn't hit my risk level, but I had too big of a position. And this is where the market humbles you. With options, all you need is 1 or 2 contracts to really make some home runs. And you don't have to have a huge size. I mean, you start getting greedy and you start seeing the dollar signs in this trading plan. And you really have to understand, where's the resistance and support levels on the underlying stock. Once you understand where those are, try to buy, like if I'm buying a put on a stock, try to buy as close to that resistance level as possible on a put for a lower, strike price, because otherwise you're going to get stopped out. Like if your risk, let's say the resistance is, any given stock at $300 and it's currently trading at 290, and you buy, so that's your support and resistance level. And then you buy it at 295. Well, you got a 50-50 chance it could go in either direction. And on Facebook, if it goes up to 300 and you're at, you bought it at 295, you're down probably a few $100s. Now, again, if that's in your trade plan, great.
Yeah.
But why would you buy at 295? Why don't you wait until it gets to, if you're impatient, wait till it gets to 298 or 299 so that you have a little bit less to worry about, because you'll just get stopped out if you buy in the middle on options. With options, understanding your entry, like where to buy, is one of the most important things, because if you don't have a good position, they decay or depreciate so quickly that you'll get stopped out every time if you have a bad position on it.
Thinking was like, if you're looking at the underlying chart and you're also looking at the options chart, and you're kind of scrolling down through this strike price and you're saying, this options chart is cleaner, it's more matching what the underlying chart is. Based off of what we've been taught when it comes down to trading, is you want to go for the cleaner looking chart. Wouldn't it make sense to try to scroll down and try to find a clean chart because it tells you an overall direction of move? Or options
you just like that? No, you just want to go with the one that's got the best volume on it. That makes the most sense. So you want the most liquid strike option that's feasible, that going in whichever direction, whether you're bullish or bearish on the underlying stock. And you just want to watch that stock. I mean, you're watching the price in the option chain, so you don't have to necessarily watch the chart, because if you pulled it up, you're double watching the same graph. I mean, they both look exactly the same. It's just that one's more illiquid than the other one, right? So you're just watching the price and making sure the price doesn't pull back. But generally I don't ever pull up the charts. I'll be honest, like once in a while I do, but it's so infrequent, it doesn't even matter to me. I'm just looking at the cues. That's the one that's the most important to me, because 90%, like most of what I trade is large caps. And if I'm not trading on a breaking news thing, that means I'm going with trend lines, basically trend lines and technical breakouts and breakdowns. And since everything trades with the cues, that's what I'm paying attention to. And it's kind of counterintuitive. I may be buying a put while the cues are going up, but the chart looks similar. It may be slanted down, but you're seeing that head and shoulders that's kind of going down. If I'm buying a put where the cue's going up, those are great, because I love buying an option on something that is going counter to the cues, because if it's going counter to the cues, something's wrong with that stock, and you're making some good money on that one at the end of the day.
Yeah, makes sense. Well, again, thank you for your time.
This has been fun.
Yeah, I'll definitely keep in contact with you, especially with the options, and maybe I'll have you on again to go into a little bit more depth, especially if I, come across some, complications with mine, because I'm going to be back testing my strategy and see if I can come up with something that's optionable as well. So,
Yeah.
and I guess we'll talk to you tomorrow then.
All right. Sounds good, man.
Sounds
Yeah.
good, Mike.
Thanks.
Enjoy your
All
night.
right. Yep. You
Bye.
too. Bye.